markets aside, the big story was further intervention by the PBOC in the offshore space. So sources have told Bloomberg that the central bank stepped in several times to support the currency. It actually worked. Shorts were squeezed. This gap between the onshore and offshore rate disappeared for the first time in months. The problem, though, reappeared, if you will, in the money markets. The cost to borrow renminbi in the interbank market here in Hong Kong spiked from a 3-4 year average of about less than 5% to 67% on the overnight rate. In other words, this intervention has really dried up supply of renminbi, and the PBOC has essentially made it impossibly expensive to borrow and speculate with the currency, and we'll continue to track that. Obviously, that one's far from over, but at least overall, there's a sense of calm, although you could make an argument that it's maybe slightly artificial given these distortions that I just talked about. David Ingles, Bloomberg, Hong Kong.
Well, that was another day and another attempt by Chinese policymakers to stabilize markets in the country. Well, now the central bank has intervened in Hong Kong's offshore yuan market, sending loan rates soaring to record highs, as was being outlined by David Ingles. So let's get out to our Asia Emerging Markets FX editor, Robin Ganguly, for more. Robin, Bloomberg is reporting that China is now intervening in the offshore yuan market again. Why, remind us, is it exactly doing this? Is this to try and stabilize it, reduce the desire to perhaps start shorting the yuan, particularly when you're offshore?
Caroline, I hate to say I told you so, but I told you so. Last week, right here, I said that the only reason why China is creating all this market turmoil over it was to narrow the gap between the onshore and the offshore rates, and they kind of achieved that today. The whole reason why they have done this is, it's very clear, right? It was very clear right from the start. They were trying to weaken the onshore yuan and push up the offshore yuan as well. At the same time, to try and create some sort of parity, get rid of people who are speculating on the currency. There were lots of people who were buying the yuan in Hong Kong cheaply, shipping it across to Shanghai and selling it at a more expensive rate. So they were kind of making an arbitrage profit from that. So that is not the kind of money that the PBOC wants. And they're trying to weed out speculators. Now it's become almost impossible to speculate on the currency at the moment.
And Robin, impossible to speculate, impossible to borrow at these sorts of levels in Hong Kong for the yuan. But has China achieved, what has it achieved after all this market turmoil? It seems to have just completely flummoxed the market and traders within it.
You've hit the nail on the head, Caroline. The thing is that they wanted to achieve parity between the offshore and the onshore rates. What they have achieved instead is complete confusion, and people who had started trusting the PBOC over the past 4 months, that PBOC means what it says, that it will allow market forces greater say when it sets its fixing, when it makes policy decisions. That's kind of pretty much gone out of the window. So what we've seen now is that the PBOC will give market forces a greater say only when it suits the PBOC. When it wants to go and do something that it thinks is in its own interest, it will not allow market forces to come in the way. Whatever happens, whether it has an impact locally, whether it has an impact in the biggest offshore yuan center in the world, that's Hong Kong, or whether it has an impact on global currency, commodity, stock markets, it will do what it is going to do. And that is going to make it really difficult to bet on the currency either way, in the short term at least.
So much for a free market. Bloomberg's Asia Emerging Markets FX editor Robin Ganguly spelling it all out for us as ever. Thank you very much. We love a bit of I told you so, don't you worry, Robin. Well, let's first of all just check in on how the European markets have been opening, and some phenomenal moves going on in the retailers this morning. We have got WM Morrison, as we were hearing from Mark, beating analyst estimates, shares surging this morning. It is leading all the retailers higher. Similarly, Debenhams is also trading higher. Here you have it on your screens. Currently, WM Morrison up by 11%. This is the biggest move since 2004 for the fourth biggest supermarket in the UK. Why? Because the first time in 4 years they managed to post positive like-for-like sales. The new chief executive managing to show us what he's made of. Meanwhile, Debenhams also trading up some 12% this morning. That's as the retailer also beat analyst estimates. It posted 1.9% like-for-like increase in terms of sales. There you have it, up 15% this morning. The biggest move since 2009 for Debenhams. So retailers putting it where their money, where their mouth is this morning. On the downside are the likes of Hayes and indeed Michael Page, as we see some concerns about human resource companies on the back of numbers. But let's look to earnings, futures, and indeed where we see the numbers going and the fundamentals of the economies here in Europe. Yogi Diwan, as Chief Executive of Hassiam Asset Management, is still with us, I'm very pleased to say. And Yogi, you are overweight European stocks.
Yes, we like
Convinced
Europe.
of that?
We're definitely convinced of that, and it's a trade relative to the US and Japan and other regions as well. The key thing about Europe is that we are starting to see reasonable GDP growth in the order of 1.4%. Unemployment seems to be controlled and is hovering around 10% or lower, depending on what region you actually look at. But the key thing here is that the euro is significantly undervalued, and this is great news for exporters and economies such as Germany. With valuations and PEs around 12, this is a good entry point for getting exposure to European equities. And when you buy European equities, a lot of the big names have global exposure. It's quite hard to buy domestic exposure, and that global exposure is a play on global growth, which will probably be a little bit better